Okay, so today we're going to discuss Introduction to Accounting. So we will define accounting, identify its users, talk about gaap and international standards, as well as accounting principles and accounting assumptions. Now, accounting is defined as the identification, recording, and communication of relevant information about an organization's business transactions. Now, for identification, it's important that we only select business transactions that are relevant. These transactions must be recorded in a chronological fashion in a summarized format. This in turn must be communicated in the form of financial statements to its users. So now we actually have two users that the financial statements are directed to. The first one is an external user. So this is a user outside the organization. An example would be creditors or lenders. They use the financial statements to assess if a company would be able to repay the loans with interest. Another external user would be investors to assess whether to buy, sell, or hold a stock in a corporation. There are also suppliers, customers, and government. Basically, it's any individual or entity that is outside the organization. So those are external users. Now we have the second type of user, which is an internal user. This is used by the ones managing and operating the business. For example, the marketing officer would need to see the financial statements in order to plan a marketing strategy that would fit the budget of the company. The human resources would need financial statements to see what the ceiling would be in negotiation regarding salary. Now, with the globalization that is happening, users of financial statements transcend the organization's borders and even the country's borders. This is why we have gaap and international standards to standardize and guide how financial statements are communicated. So the gaap, or the generally accepted accounting principles, is a set of rules that guides organizations in summarizing and organizing their financial information and statements. This is the commonly followed rules of accounting from one organization to another, whereas the International Financial Reporting Standards serve as the guidance for accounting practices from company to company, country to country. So this is issued by the International Accounting Standards Board. So this is to standardize accounting regardless of country. So now, aside from these rules and standards to follow, we also have accounting principles and accounting assumptions to guide us. Let's first talk about accounting principles. So, under this is cost principle. This states that assets must be recorded equal to the amount of cash or cash value paid. So this basically means that however much is paid should be recorded. For example, a used car is being sold as 500,000 and the buyer pays only 450,000 and the seller agrees to that amount. So the one listed and recorded is 450,000 as it is the cash value received by the buyer. Second is revenue recognition principle, which states that revenue must be recorded when the goods and services have been earned, regardless when the cash was received. So this is mostly for accrual accounting. For example, April 5, we mowed the lawn of a client. However, the client will be able to pay us on April 15. So we record this transaction on April 5 as that is the day that we rendered our services and not on April 15. So next is the expense recognition principle. So we only record the expense when the revenue that incurred the cost has been generated. So for example, on the month of April, we buy calculators to resell in our business for 5,000 pesos. However, we were only able to sell all the calculators on May for 10,000 pesos. So with this principle, we will record the expense on May as recording it in April will overstate the expenses on April by 5,000 and understate the expenses on May by 5,000. So next is the full disclosure principle. The company must state details that a user must need to know to make decisions based on the financial statements. So for example, we must disclose loan agreements, its maturity, its interest, and terms as part of our financial statement so that investors would know what the depth of a company is. Okay? So those are the 4 accounting principles. So now let's go to accounting assumptions. First is going to concern assumption. So this is the presumption that a business will keep on doing its operations unless told otherwise. So this is specifically to report a sale for its cost and not liquidation values when we assume closure. Next is the monetary unit assumption. So monetary unit is the currency which financial transactions are expressed, whether that be peso or dollars or yen. Next, we have the time period assumption, in which the life of a business is presumed to be divided into quarters, years, or months. Now lastly, we have business entity assumption, in which we keep the transactions of the business separate from the personal accounts of the owner. So we only record, for example, the withdrawals of the owner, but we don't record what he or she does with the withdrawal, i.e. buy a car, under the expense of the business, as that is a personal expense. So that would end our discussion on the introduction of accounting. So we defined accounting, we identified its users, talked about the gaap and international standards, as well as accounting principles and accounting assumptions.